So, hi everyone, I'm Debra Brady from Coast Capital, and I'm joined here with accountant and TurboTax spokesperson Susan Watkin. She'll be answering some of our most frequently asked questions about taxes. Thank you, Susan, for joining us.
Thanks for having me. It's nice to be here.
So, for those still working from home, can you explain a bit about how they can claim their work from home expense deductions?
Well, as you remember, in 2020, the government had brought out the temporary flat rate method for those of us working from home due to COVID, to claim some deduction back for our work from home expenses. So this past year, the federal government has decided to extend that into tax years 2021 and 2022. And they've also increased it from a $400 maximum to a $500 maximum. Now, the eligibility criteria still exists. It's still the same thing. So you had to have been working at home due to COVID for a minimum of 4 consecutive weeks, 50% of the time. And then that would allow you to claim those $2 per day up to that $500 maximum.
Okay, that's very helpful. Question number two, many people have started working for themselves as a side gig or even a small business. So, what does that mean for them and their tax returns?
So now we're going to be having self-employment income. Self-employment income is business income, and now business income is reported on the T2125 form. Now this form is a part of your personal income tax return. So this is where you're going to be reporting not just your income but also the expenses related to that business. So and it's important to remember that when you're getting yourself ready to go for tax time, that you're getting all of that stuff for your business together. So all your revenue, all of your expenses, consider that you may be eligible for things like business use of home expenses or even business use of a personal vehicle expenses. And then those net earnings from that business is what gets transferred into your total earnings on your individual tax return.
Very helpful. Thank you. Often going to school or starting a new job means a move. Are taxpayers able to claim moving expenses?
Yeah, so well, there's an eligibility requirement there, and if you've had to move to start a new job or go to school full time, if that was at least 40 kilometers closer, so you're moving closer to the job or the school, then it is likely that you can claim some of your moving expenses. So a lot of those expenses are going to include things like travel expenses, so your vehicle expenses, meals, even some accommodations. We have to keep in mind too, though, that these deductions that we're making are deducted off of the earnings of that new job. So you can only deduct so much based on what you've earned on that new job you've moved to, or the earnings that you're getting from going to school, for example, like scholarships, bursaries, etc. So it's really important to make sure that you keep all of your receipts together to see if you're eligible to claim those as well. And now there may be some other things you might be able to claim. So certain things like costs for selling your home, even legal fees, real estate commissions, some kind of temporary housing sometimes. So if you've had to move and you've moved at least 40 kilometers closer, definitely look into this deduction to see if it's something that you could qualify for.
Okay, I didn't know that. That's great. So, some individuals are filing their taxes on their own for the first time, many getting that first formal job after finishing school. Any tips for them on keeping it simple and stress free?
Yeah, so yeah, coming out of school or filing on your own for the first time, maybe your parents were doing it before, now you started working. It's important to just look back at your year. So look back at 2021. What happened to you? Did you go to school? Did you move? Did you get married? Get all these documents together, everything that you would have received from an employer, your business information if you started a side gig, for example, school documents. I always recommend to everybody to make sure to sign up for the CRA My account. This type of access is going to allow you to log in and be able to see everything, all the information the CRA has on you. So whether it's personal information, tons of tax forms, your T forms, your RRSP or TFSA contribution limits, tracking that refund hopefully that you're getting, or even making changes to your personal information. This is a great thing to have. Another thing that you could do to help yourself out as well to prepare, if you especially if you've been coming right from school, is to decide what you're going to be doing with those tuition tax credits. Remember that if you don't need to use them, you can transfer them to a parent, a grandparent, or a spouse or partner, which is always kind of nice, especially if they helped you pay for school in the first place. And if you don't need to use them, then not to worry, they will carry forward to your next tax year. And then ultimately, of course, just remember you don't have to go it alone. Right now, for those aged 25 and under, as of the end of 2021, TurboTax is offering them the opportunity to complete their tax return and using any version of TurboTax Online, Assistant Review, or Full Service free of charge. So if you're feeling a little nervous going into this for your first time on your own, then be sure to consider using Assistant Review, get the help from an expert walking you through, or use Full Service where an expert will do it for you and get the best return possible.
So, if individuals did some investing last year, either to their RSPs, TFSAs, or even stocks and bonds, how does that impact their tax returns?
RSPs are those contributions are deductions on your tax return if you choose to deduct them. So anything that you contribute throughout the period that goes for this tax return, so RSPs, that would have been from last March up until this end of this February, is those you have to report them on your tax return. However, you don't have to necessarily use the entire deduction if you don't need it. But if you do, what that deduction is going to do, it's actually going to reduce your total income before the taxes are calculated. So that's a nice deduction to make sure you get on your tax return if you want to lower that total income. TFSAs are tax free. So, unlike our RRSPs that are tax deferred, TFSAs actually have nothing to do with our income taxes because we're not paying any taxes. So, we're not declaring it, and then we're not getting any benefit on our tax return either. So, now when we look at investments, when you're thinking like stocks and bonds, so we call that property, those become a part of our tax returns when we sell them. So, for example, if you've purchased stocks, purchased bonds, and then you've gone and sold it, and then the amount you've sold it for is higher than the amount you purchased it for, you have a capital gain. If it's less, you have a capital loss. Now, both of these things you put on your income tax return. And then definitely, if you've invested in your RSP, you want to make sure if you need that deduction, put that deduction on your tax return, help lower that taxable income straight away before the taxes are calculated on it. Be sure to remember as well to declare any carrying charges or interest that you have paid in order to earn money from your investments. Now, keep in mind, however, that interest paid on a loan to get money to contribute into your RSP is not an eligible deduction. So be sure you're careful with what you're claiming there and making sure you're taking advantage of those carrying charges or interest deductions if you can.
Okay, thank you, Susan, for taking the time to answer all of our tax FAQs. You've offered some really great advice today. Thank you so much for joining us.
Thank you for having me.